This video is sponsored by Momoraitsoch Tech and Tools. Get your everyday electronics like chargers and earphones, as well as your blackout essentials like power banks, inverters, and UPSs. All at prices that keep real people in mind. Use promo code MIKE10 to get 10% off your order. Momoraitsoch, it's about people. Hi there. Welcome to my channel, where I dive into fascinating economic trends and analyze their impact on society. Financial bubbles, akin to a dark, exhibit distinct characteristics that can help identify their existence and potential impact on markets. These bubbles, driven by a collective enthusiasm or speculative behavior, can lead to unsustainable asset price increases and subsequent market crashes. In this discussion, which is part one of a new series on financial markets, I shall delve into the concept of financial bubbles, exploring their key indicators, historical examples, consequences, and possible strategies for detection and mitigation. Furthermore, I shall address the role of regulatory measures in preventing or managing the adverse effects of such bubbles. I should put in a disclaimer that this episode and all episodes in this series are not meant to offer any financial advice to anyone. My approach is to discuss high-level finance concepts without getting into the woods of day-to-day personal financial advice. And so no one should use these discussions to engage in any investing activities. Before I continue, however, do visit our website where I curate news and publications from international financial organizations and world central banks. Topics cover a wide range of financial and economic issues that affect individual countries or the world economy. For instance, COVID-19, inflation, or the war in Ukraine. Please also subscribe to this channel and be informed whenever we publish a new video. Financial bubbles often manifest through specific indicators and behavioral traits. Rapid asset price escalation fueled by investor psychology, specifically the fear of missing out, irrational exuberance, and speculative behavior are a common feature. Additionally, increased trading volumes, excessive leverage, and a disconnect between asset valuations and fundamental factors may signal the presence of a bubble. By examining these indicators, investors and analysts can gauge the likelihood and potential severity of a bubble. Several notable historical examples illustrate the impact of financial bubbles on markets. The tulip mania in 17th century Netherlands, the South Sea bubble in 18th century England, and the dot-com bubble of the late 1990s saw an unprecedented surge in prices. In the dot-com bubble, companies with little or no earnings were valued at exorbitant levels, reflecting speculative fervor. When reality set in and investors began to question the sustainability of valuations, the bubble burst, leading to significant market declines. Another pertinent example is the housing market bubble that triggered the global financial crisis in 2008. Easy credit, lax lending standards, and a belief in perpetually rising home prices led to an unsustainable surge in real estate values. However, when the underlying mortgage-backed securities turned sour, the bubble collapsed, causing widespread financial turmoil and recessionary pressures. Financial bubbles carry significant risks for economies and financial systems. When bubbles burst, asset prices decline rapidly, leading to substantial wealth erosion for investors and potential financial instability. The aftermath can result in reduced consumer spending, business investment, and employment, contributing to economic downturns. Moreover, bursting bubbles can have a cascading effect, impacting other sectors and markets interconnected with the initial bubble, amplifying the systemic risks involved. Detecting financial bubbles in their early stages can be challenging, but is crucial for mitigating their adverse effects. Market participants and policymakers can employ various strategies to identify and address potential bubbles. Robust risk management practices, including stress testing, scenario analysis, and careful monitoring of key indicators, can help identify vulnerable areas within the financial system. Furthermore, effective regulation and oversight are vital for maintaining stability. Regulatory authorities should ensure that lending standards remain prudent, monitor excessive leverage, and implement mechanisms to detect and address asset price bubbles. Promoting investor education and awareness can also aid in mitigating the impact of speculative behavior and promoting more informed decision-making. In conclusion, financial bubbles resemble a duck in their observable characteristics and behavior. By understanding the key indicators and behavioral traits associated with bubbles, investors and analysts can better identify their presence and potential risks. Historical examples such as the dot-com bubble and the housing market bubble highlight the consequences and risks these bubbles pose to economies and financial systems. Strategies for detecting and mitigating bubbles include robust risk management practices, effective regulation, and investor education. By carefully monitoring and addressing the signs of financial bubbles, market participants and policymakers can work towards a more stable and resilient financial system. That's it for today's video. I hope you found this analysis insightful. If you did, please like this video and don't forget to subscribe to our channel for more engaging content like this. As always, I appreciate your support. Thank you for watching, and until next time, stay curious and keep exploring the world of economics.